Hello, investors. It's Don Vandenbord, Chief Investment Officer with Revere Asset Management. Today is Thursday, December 26th, 5 o'clock Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Roundup Daily Market Insight video. Day after Christmas edition. I trust everybody had a good Christmas for those who celebrate. So, state of the market, we're in an uptrend. Check the trend gauge over here. Certainly didn't look this way when we closed last week after a big negative reaction to the Fed meeting on December 18th. And then a follow through to the downside on Thursday, but a cool PCE inflation report on Friday sparked the rally. That followed through on Monday and Tuesday. And today, day of rest time, with a switch in leadership. Small caps have been lagging noticeably. They let us off of the gap down low today, mild gap down. But small caps did gap down 0.6%, put in a low right away, and led the way to the upside today. Looking at the trend gauge over here, leaders acting just fine. Green arrow there. Short term and medium term, we've got more of the major indexes below their respective short term 21-day and medium term 50-day moving average, but the S&P 500 and Nasdaq 100, led by big cap tech, continue to reside above those key levels. All the major indexes are above their long term 200-day moving average. Market never gets into serious trouble unless you break that 200-day moving average on the indexes. So what happened today? As I said, mild gap down open, tied to a pick up in interest rates uh, after the Christmas holiday, but those faded and ended up being interest rates basically closed near flat on the day. And as I said, after the gap down open, small caps led the way. Now we've got a setup there with extreme oversold conditions in small caps to go higher. In fact, all eight of the RG8, that's our eight growth ETF composite, hit oversold and did have their stochastic hook higher. So we're also very close to, if not, it doesn't update until 6 o'clock Eastern time, but I think the NASI, the McClellan Summation Index, got a hookup from oversold conditions as well. So these are tailwinds that can continue to carry us. We are in this 7 day. It's the last five trading days of the year and the first two trading days of the next year, the so-called seasonal Santa Claus rally, and see if we stick with that historical norm, and see if today was a switch in leadership. We're always on the lookout for what's leading the way. Growth leaders have been acting well. If we get small value in gear as well, and breadth increases, we could have a very nice rally into the end of the year and the beginning of next year. So gap down, open, small caps led. Here are the numbers. The 21 over 21, nice day today. 13 up, 6 down, 2 neutral, up almost 1% on average. The big eight, as I mentioned, the Mag 7 lag, big eight down 0.6%. The RG8 up an average of 0.4%. Most of the indexes barely positive or negative, again, with the exception of small caps that were up 0.9%, mid caps up 0.3. We'll look at those charts momentarily. Let's get into it, and we'll start with the S&P 500 as we always do. You can see the pretty quick recovery from the waterfall event that happened last Wednesday afternoon after the hawkish cut. That was Powell saying they didn't have a clear reading on the data. They reduced the number of cuts for 2025 from 4 to 2. Big sell-off Wednesday. Thursday afternoon, we gapped up right into the 50-day moving average, closed near the lows of the day. So that was more bearishness. That bearishness continued overnight into Friday morning. PCE data came out Friday morning, and that led to a move well off the lows. Let's take a look at the 5-minute chart here. Well, probably better on a 15-minute chart here. Here's the waterfall I was talking about. Here's the gap up and the failure. There's we opened red on Friday, but well off of the lows. and streaked our way higher most of that afternoon. A little bit of fade into the close. This was also when there was a lot of arguments going back and forth about the potential government shutdown, but that was alleviated as well. And then you see Monday, Tuesday, the shortened holiday where the bulls in light trade really put the pedal down, and we held those gains today. Take trading range um, still below all-time highs, back around 6,100 is acting as some pretty strong resistance. You can see it all the way back here at the beginning of December. So that 6,100 level is the key overhead level that we're looking to break through if you're a bull. But for now, we'll settle for regaining the 8-day and 21-day moving averages, and that's a good line in the sand along with that 6,000 level on the S&P 500. Onto the Nasdaq 100, the leading index, which it did make highs, while the S&P did not. Still had the same big shake last Wednesday and Thursday. The undercut and reclaim on Friday, back above the 21 on Monday, back above the 8 on Tuesday, and a tight range day today on light volume. Resting after that 3-day move back up off of the 50-day moving average. That looks pretty darn good. Let's go to the Dow Jones Industrial Average. Dow still trapped below the 50 and the 21-day moving average. 50 is basically flat. The 21 is declining, although we have had 5 positive closes for the Dow now. Let's go to mid caps. S&P 400 mid cap index. Still far below the 50-day moving average. The 21 has crossed below the 50-day. 4 positive closes right into the declining 8-day moving average. Need to get back above this 3,200 level and make a run at the 50 and 21 key moving averages. Russell 2000 small caps. Very similar chart right into the 8 EMA today below the declining 21 and flat 50-day moving average. Let's look at the equal cap weighted S&P 500 very quickly. Also right into the 8-day moving average below the declining 21 and 50-day moving averages. So those are the major indexes. Again, same situation with the S&P and the NASDAQ 100 leading the way from a relative strength standpoint, but possible setup now for small caps to uh, to take the lead. Setups there, they're very oversold. We'll take a look at the RG8 ETFs here momentarily, but let's get through the first, all of the inter-asset correlation that we do every day, and we'll start with the VIX. VIX down again, 14 handle, pretty good for bulls. We're quite all right with that, below the 21-day moving average. Now, some things that aren't so beneficial. We'll start with the dollar. It's consolidating up here after a big move up the prior 3 weeks. That big move up corresponded with pullback in the indexes. We're right at that 108-ish level for the dollar. Dollar usually has an inverse correlation with precious metals. Here's GLD below the 50 and 21, though positive on the day. GDX, gold stock. That's a terrible looking chart. Minor move up today, and silver sitting right on the 200-day moving average. Bitcoin can't get back above that 100K level. Did close above the 21-day moving average on Tuesday, back below it today. So a little bit of ping pong versus the 21-day moving average there. Let's go to bonds then. Tight range today. Yields started out higher during the day and faded. And not a whole lot of change in Bonneville, BND, slightly positive, TLT, slightly negative. Let's do the RG8. We'll go through them, and I'm going to turn stochastics on so you can see how oversold these things have gotten. Now they can stay oversold for a while, as they did back here for a period of 1, 2, 3, 4, 5, 6 weeks. We're just coming back. No, this is TLT. I'm sorry. Let's go with IWO. Here we go. So here we're oversold. We did have the stochastic cross back up, still below that key 20 level. So Several times you can see on this chart when we got back below this level and cleared the 20 level, it was a short term, at least, relief rally. So again, that's what we're set up for. Still below the 21 and the 50-day moving average. It's pretty consistent that you'll see the declining relative strength and then below the 21 and the 50-day moving averages and oversold on the stochastic. So again, the setup is there, but a setup is just a setup without follow through and a trigger. So IWO, that's the small cap Russell 2000 growth. Next up, SLYG. This is the small cap S&P 600 growth. These are a little bit better quality companies. Same setup there, though. Below the 21 and 50-day moving average, stochastic hook up from deep oversold. Next up is MDYG. This is the growth portion of the 400 mid cap. Same setup there as well. Then we go to QQQJ. This is a mid cap NASDAQ 100. Looks better. Off of oversold and above the 50-day moving average, right into the 21-day moving average. So we're getting a little bit better then. Here, how about PDP? This is a momentum ETF below the 50 and the 21, but closer to the 50, again, coming off of oversold. Next up is SPHB. This is large cap high beta with a growth slant above the 50 right into the declining 21. Has already come off of over sold. FFTY above the 50 and the 21. And again, this is indicative of how leading growth stocks have been outperforming. We dipped below, but this was the first of the RGA to get back above the 50 and the 21-day moving average. Just barely got into oversold territory. And finally, Kathy Wood's ARK-K, led by Tesla, which has been acting very well. This didn't even make it to oversold. Brief dip below the 21, never came to the 50-day moving average. And again, that's because of the big heavy weights that she has in some of the leading names there. So the RGA, the setup is there. That carries over to mid, small, and growth companies. And while we have this turned on, let's quickly look at the broad S&P 400, also in oversold. The Russell 2000, also an oversold. Coming off of it, RSP, also coming off of oversold. Uh, Obviously, the QQQ came down from oversold with the pullback last week and is in the middle of the range. Same thing with the S&P 500 in the middle of the range. So once again, the setup's there, but again, a setup is nothing without a trigger. Let's go to the tail of the tape now. You can pause this. I'll hit the highlights. As I said, improvement with the stochastics. NASI coming off of oversold. Dollar and yields still headwinds. Something to be concerned about. Percent of stocks against their 5-day moving average. Nothing is ever perfect. When you have a big move like this in a short period of time, we went from extremely low, that's under 20 on the percent of stocks of the S&P 500 against their 5-day, to extremely high, we're over the 90 percentile on percent of stocks above their 5-day. And if you look at that chart, the 20 below the 20 is a buy, over 90 is kind of a chill. But again, these are secondary indicators. There are really more that are pointing to the upside than they are to the downside. But don't be surprised if the S&P 500 with this big move up pauses for a little bit and small caps take the lead, which is kind of what we saw today. So in the news, this is day 2 of that 7-day seasonal Santa Claus rally. The 7-day average return is plus 1.3%. We're basically there, up 1.1% on Tuesday and just down fractionally today. I remember last year, the gain was all in the last 15 minutes on day 7. It was some serious tape painting going on in the second trading day of the year. Keys coming into today, S&P against the 21, still above that. NASDAQ 100 against the 8 and 21, still above that. Leaders mostly to the upside, but there was some negative mix shown in there. So we'll give them a neutral. Rates pulled back. Well, really no change. So we'll give that a neutral as well. Day count from up 2 to up 1 to up 2 with a 1-day consolidation. 2 days above the 8 and the 21. Expectations are positive with the S&P and the NASDAQ 100 above their 21-day moving averages. Not a whole bunch of standouts in sectors today in the tight holiday trade. But banks, retail, and biotech led to the upside. To the downside, Mag 7 and XLY, which is chiefly Amazon and Tesla. There's the portfolio. Only changes today. We added to SSO with that early pullback bounce where it should have been off the 8 and the 21 day. So we added to that and also added a little bit to AVGO. Show some nice leadership quality action there. Revere volatility adjusted beta 1.32. Reminder 1.00 as if you were 100% in the S&P 500. So with us being above the 50 and the 21 on the big moving averages, we want to have more exposure to the market than a 1.00. And then rebar, this is our Revere estimated balance at risk. This is if all of our stops got hit. The downside approximately 6.15% from where accounts sit now. That would include all leaders being sold and the S&P 500 breaking the 200-day moving average. So bottom line on the day, gap down open, small caps led the bounce. Will that continue? We'll take a look at Friday's keys in Friday night's report, but we'll be looking at the S&P against the 8 and the 21, same with the NASDAQ 100. See if small caps maintain that leadership and see if we can get a pullback in rates. We'll update those keys in Friday night's video. There's no podcast this week as we take a break for the holidays, but we'll be back a week from tomorrow with the podcast. And let's take a look at a couple of names. Let's turn the stochastics back off and let's go through the portfolio, everything that we own. 9 names plus Bitcoin. Some of them down today, but still overall decent return, beating the S&P 500 slightly. A-Lab, part of that, up 3%, just trending very nicely above the 8. Reddit, gapped up, pulled back to slightly negative, but that chart still looks fine. Palantir. Notice these are all above not only their 21, but above the 8 as well. That's ideally where we'd like to see it. The perfect buy and hold while it trends above the 8-day moving average. Start to take some off on a break of the 8. You run for weeks, the 21 will be above your buy point. So set the stop down to the 21. That's kind of what I do, lather, rinse, and repeat over and over again. Bros bounced off the 21 last week, back above the 8 again. Tesla, big move up on Tuesday, gave back a little bit today. Google, tight action the past 3 days. AVGO, definite leadership quality since that last earnings report. And GEV, tight action back above the 8 and 21. That's what we hold in the portfolio. And with that, I'm going to wrap it. As always, like to hear from you. The email is don@revereasset.com. Phone's 855-REAL-WEALTH. That's 855-732-5932. If you're interested in becoming a client, you can email me or my partner, Dan Stewart, Don or Dan at revereasset.com. And, Connor and Ted do these videos too. You can email them as well, Ted at Revere, Connor at Revere. And our newest addition to the team, Todd, will be starting doing these videos sometime early in the first quarter. He is Todd at revereasset.com. Reminder, our flagship portfolio is named GROTECTION because, well, it does what we say it's designed to do. That is participate in uptrends. That's the grow part. And get the heck out of the way in downtrends. And been getting a lot of kind comments over the holidays from clients recognizing that we do what we say we're going to do, and that is smoothing out the equity curve by getting out of the way when the market's unfavorable, and then at the same time participating when the market's acting well. If you have any questions, reach out to us. And with that, I will wrap it for Thursday, December 26th. This is Don Vandenbord with Revere Asset Management, telling it like it is. Thanks for listening and have a great day.